One, that negative real yields are associated with monetary stimulus, right? And that's continued to push through the system. And it's anticipating that more stimulus is coming, not just by the Federal Reserve, but by other central banks. Because in the end, if this reopening that we're having now, even though it's very fragile, central banks want to get inflation back to target, and they're going to bring rates down or keep them low, let inflation go run higher. That's one reason why real yields are negative. The other part, though, is that it can signify that it's maybe weak growth here in the United States or not strong growth. You see, for example, the real yield in China actually moving up. And I think that is also an interesting dynamic as we look at these tensions as they're happening. The Chinese economy is pretty resilient, but the real yields in China are up. So, I think it's a picture of mixed of weak growth here, stronger growth in China.
Yeah, but yields go down when people buy bonds. You raise yields when you want people to buy bonds. We don't need that. There's obviously plenty of buyers. Why are there so many buyers of U.S. government bonds, Ben, when they are effectively getting a negative real yield? They're in a way, sort of losing money by owning bonds, but it's not stopping them from owning them.
Yeah, it is a bit of a quandary, I think, because you're right. You do not get paid here. Your coupon interest is low, and then you're having a negative real yield, but basically you're getting a tax on your bonds. But I think investors looking at it from one, there's where the liquidity in the markets is. So I want to own that against a continued very uncertain backdrop. Two, the central banks are buying bonds, so I think that doesn't incentivize people to own bonds too. Lastly, the inflation picture yet hasn't really emerged such that it would threaten your bond holdings for that reason, right? That yields will go up really quickly. So I think all of those play a role why people want to have bonds. In addition to that, it reflects just the economic environment, particularly the United States, being somewhat uncertain at this moment.
You mentioned China. We kind of had this before in 2012, and that was the start of kind of a Chinese reflation. Our markets benefited as well. Are negative real yields a warning sign, Ben, or are they an opportunity?
I think they're more an opportunity. I think that it is about getting negative real yields for a period of time because of this uncertainty, and it also incentivizes people to look elsewhere, whether that's in foreign markets, or China. But it also is an opportunity to, reallocate your savings that are actually being taxed now as we speak, right, to, better yielding opportunities. And I think this is where we're going from here. People were going to take that opportunity from negative real yields to, say, the reopening stocks again as we hopefully get out of the virus situation.
All right. So you mentioned international, Ben. Do you think that foreign markets are a better bet than the U.S. markets right now? And I mean stock markets. Should we buy the Brazilian market or the Asian markets over the U.S. market?
I think you want to own both, but I think there's a point here that we are faced with a challenge with getting the outbreak under control. And we've learned now that the only way to really get it under control is to keep activity really slow on the ground. So yet you're seeing the acceleration happening in both Europe as well as in Asia. The PMI data overnight showed that. So I think this is, how you want to play it, that you're keeping, let's say, 60% in your foreign markets and keep 40% in the US markets to go through this period. Obviously, the US market had a lot of value from a technology point of view, but the reopening trade currently here is somewhat on the weak side. So I would play that more foreign.